You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means we are back once again. It is Thursday. It is 1:30 p.m. Central. It is 2:30 p.m. Eastern. It is time once again for TWIFO, This Week in Futures Options, a program where we break down all the action going on the futures options side of the fence. Let me talk some ags, maybe some metals, maybe some rates, maybe some FX. You never know what's going to make it onto the show each week. That's why you got to tune in. My name, of course, Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we tend to think so around these parts. We may be a little biased. Options Insider Radio Network. Of course, you guys, if you like what you hear, keep rating and reviewing. August, the busiest month in the 15-plus year history of the network. A lot of that due to a lot of new folks discovering the content. So if you like what you hear, keep rating and reviewing. Really does help the new folks continue to discover the content, even stuff that's been running for a long time. Over a decade, like VolViews and all of our other good stuff, Options Bootcamp, all of our long-running shows, continuing to attract new listeners. So your ratings and reviews do help. And of course, if you want to go above and beyond, you want to get access to, let's say, our great pro Q&A sessions, of course, Options Oddities, the end of every week where we break down the mad week of unusual activity, giveaways, live access to this and everything else we do, and a whole bunch more. TheOptionsInsider.com/pro is the place to go to join the fun party that is going on over there. I see you guys having fun over there while I'm trying to host a show. And of course, joining me here in the old CME Group and FTSE Russell hot seat today, our old friend, Mr. Rich Excell, the Assistant Professor of Finance and the Co-Director of the Investment Management Academy over there at the University of Illinois. Rich, welcome back to TWIFO, sir. It has been too long.
It has been a long time, Mark. Glad to be back. Glad to be here. It's a pretty interesting and exciting time in the markets.
Yeah, you picked a good one. You picked a good week to come on. We have a lot to talk about. So let's get to it. It is time for the Movers and Shakers Report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everyone, welcome to the Movers and Shakers Report, the portion of the show where we break down everything lighting it up to the upside, a.k.a. the light side, and, of course, to the dark side over there at CME this week. And we are back, I won't say to normal, but we are not quite as biased as we have been in recent weeks. There were some weeks there where we struggled to find a top and bottom five. We put together, let's say, a dark four or a top three. This week, we can at least make a top and bottom 10, even if our data is, shall we say, slightly red skewed this week. All right, Mr. Rich, you know what happens next, sir. Where should we begin our journey this week? To the light side or to the dark side?
That's a great question, Mark. A lot of negativity out there. I think we should start on the light side and really kind of start at the high
Mix
end
it up.
of what's going on.
Start positive. Yes. Okay. I'm picking up what you're putting down here. To the light side we go, listeners. Of course, you guys can find this report for yourselves. If you follow CME Group on Twitter, they tweet it out there. We always tweet it out right before showtime as well. Number 5 to the upside, to the light side this week, we have soybean oil. So off to the beans, up 3.19%. We're hanging out in ags a lot to the upside this week, listeners. Number 4, KC wheat, up 5.1%. Number 3, heating oil, our sole non-ag on the list this week, up 5.16%. It was number 2 in the other direction last week, off nearly 10%, 9.91%. So rocking couple of weeks for heating oil. Unfortunately, as we've discussed on the show in the past, not really a huge options player out there. Number 2, it's oats, up 5.33%. And again, another one that does some movement, doesn't really do corresponding options numbers, unfortunately. So not a lot to sink our teeth into in oats. And number 1 with a light side bullet this week, we've got SRW wheat, a.k.a. Chicago wheat, up nearly 7%, 6.98%. So I got a feeling we might be hanging our hat in some ags this week. But before we do that, let's go out to the dark side this week. A lot of our frequent offenders can be found. In fact, all 3 of our frequent offenders can be found to the dark side this week. And if we extend it to, let's say, a bottom 6, then we can get all of them in there, because our top 3 frequent offenders, listeners, we have Bitcoin, we have nat gas, and we have lumber, all 3 of them in the bottom half, the dark side this week. Let's extend it to a bottom 7. Why not? Because the E-mini S&P off 3.5%. Number 6, we've got Bitcoin off 3.8%. Hanging out below that 20K level for most of the week out there this week, listeners. Number 5, back to the name we don't talk about a lot on the show, the E-mini S&P Mid-Cap 400, off 4.82%. Number 4, off to the SOFR. We don't get the SOFR that much as well. The 3-month SOFR off 4.89%. It was number 1 to the dark side last week, off a whopping 15%. Of course, we are in rates season, listeners, with the Fed talking, so we expect to see a little bit of action out there. Number 3, lumber. This is a product. If I could name one product that I wish did more options paper over the last couple of years, it would be this one. It would be lumber. This thing has been moving all over the place for the last couple of years. Dead trees, the hottest commodity, the hottest thing on the planet. Forget Bitcoin, forget meme stocks, dead trees. And yet, alas, no real options paper to speak of. Off 5.14% this week. It was number 5 in the same direction last week, off 2.42%. Number 2, our old friend, the Russell 2000, getting a little bit beat up this week, off 5.25%. And then number 1, another one of our frequent offender this week, is nat gas, off 9.84%. It was number 3 to the light side last week, up 5.36%. So we've got the Russell 2000 at number 2. We've got the E-mini sneaking in there at number 7. We got the S&P mid-cap at number 4. Rich, I know you've been pretty active in the equities as well, so we're going to hang out there first.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everyone, welcome to the wild, the wonderful, the topsy-turvy world of equities out there right now, listeners. And it's one of these markets, yet again, where if you don't like where things are going, just wait 5 minutes, because chances are we're going to have a nice whipsaw or something else going on out there. Coming into showtime, most of the equities decidedly red. Powell sticking a little bit of a knife in the markets again out there this week. Coming into showtime, we're seeing vol, the flip side of the equity coin, mostly north, listeners. You got RVX, so the VIX of the small caps, a little bit north of 32.12, up about 1 2/3 points from where it was this time last week. So once again, firmly in the 30 handle again for small cap vol listeners. A VIX following suit, not quite as frothy, but pretty close. About 27 2/3 when we kicked off the show, up about 1 3/4 points from where it was this time last week. VVIX, so the vol hanging out a little bit shy of a 90, about an 89.70, off about 1 1/4 points, but still a pretty frothy out there. Vol Q, so the at the money vol of the NASDAQ 100, about 32 2/3, so up about 1 3/4 points from this time last week. That puts both of those spreads not really moving a ton this week, as you can see. The VIX to RVX, so the large cap to small cap vol spread, hanging out at right around 4.5, about 1/10 of a point tighter than it was this time last week. Still pretty wide. And the VIX to vol Q, so the NASDAQ to S&P vol spread, hanging out just a blip below a 5, a 4.97. It's about a nickel wider than it was this time last week. So a lot to unpack. Let's start there, Rich. I know when you're not talking to me, you're busy putting out a lot of reports over there at CME, including your Excell with options report. And it seems like you've been taking advantage of a little bit of Fed vol and exploring the new short-dated E-mini options. What's been lighting up your tape this week, sir?
Well, especially when we look at the E-mini market, with all of these daily options that we have, we really have the ability to isolate onto a particular event. In the case I looked at this week was the Fed event, right? That is the big event for all markets. I mean, you just looked at.
Was there a Fed this week? I wasn't paying attention. I must have been.
Exactly.
I must have been busy
I'm not
elsewhere.
really sure what happened either. But yeah, you talked about it in the dark side, SOFR on the radar, right? So people are not only caring about what the Fed's doing this week, but they care about what the Fed's going to be doing the rest of this month and rest of this year. The next 12 months or so, and that's impacting risk as we see across the board. And we saw on the light side, with food prices still heading higher, the Fed might still have some work to do. And so what I was looking to do is try to say, what's priced in? I mean, when you looked at what's going on with the vol market, one of the things that's probably has surprised a lot of people is that on these down moves that we've had in the equity market, that the VIX and other option products have not, the volatility, implied volatility has not been responding as one might expect. And so what I looked at is what's really priced in, looking at a Tuesday, Wednesday spread, isolating for that particular event on Fed. And then what I noticed when I priced that out and bootstrapped what the one-day straddle was priced at, because I looked at it a week ago, you can see that it was priced in about a 2.4% move, a little under 2.4% move. If you look at the movement that we saw at all of the other Fed meetings this year, the lowest amount of movement, high to low, that we saw on Fed Day was 2.5%, and most of the days were in excess of 3%. So you look at it and say, okay, is this meeting going to be potentially more or less volatile than the previous meetings we've seen this year? If your view is, as mine happened to be, that I think that was going to be at least as volatile as the other days we would see, buying something at about 2.35% one-day straddle looks to me to be relatively inexpensive. It seems to be a pretty good reward to risk trade. And then what do we see yesterday from high to low? Moves over in excess of 3% yesterday. So it was, that sometimes you just have to ask yourself what's priced in. I mean, there's a lot of, especially when you're looking at a lot of the trend in the equity markets, there might not be a lot of difference of opinion, but sometimes you can try to back out a trade by trying to figure out what's priced in and where you might be able to take advantage.
Yes, I was talking to people yesterday. They were also loading up on some S&P straddles. It was the day for S&P straddles, it seems like. But a lot of people have also been talking about playing around in these new short duration. Obviously, we have expirations popping off pretty much every day out there these days in the S&P. Rich, I'm curious, what's your experience been like out there? How are you finding the liquidity in some of these trying to do spreads, day to day and intraday type spreads? How has that experience been like for you?
Well, I think what we're seeing is that, and probably to the consternation of a lot of people that use volatility forecasting tools, a lot of the volume is in these short dates. Now, not so much on every given day, but certainly around the bigger catalysts. I think we see a fair bit of volatility. And I started my career in foreign exchange, and if you kind of go back to the world of foreign exchange, even 25 years ago, we would have twice daily expirations globally, right? So you would have every week you would have 10 different expirations to play with, and so we're starting to approximate that in a lot of these listed equity options that we have.
Well, let's get on out to the E-mini, see what was lighting it up out here on this Fed week. Listeners coming into Showtime, we're at a 37.77, off a whopping 113 handles on the week here, listeners, and nearly 3%. So obviously a red week for the S&P. And in terms of action, like Rich said, if you're looking at anything beyond a week or two out here in any major equity option, you're missing the lion's share of the story, because that's where pretty much all the action is. And that is the case again this week. By the way, how much paper going up in this Fed week? 3.2 million contracts on the tape right now. So a fair amount of paper. Of that, about 21% going up in the contract that goes away tomorrow. So we'll hang off maybe looking at vol and skew, because those are kind of subjective terms when you're getting that close to expiration. If you are curious about a 32 3/4 for the quote unquote vol out there. And in terms of action on the E-mini, we are still seeing a lot of those, shall we say, nonsense puts. 32 half puts going away in a few minutes have traded about 41,000 times this week. So there still is a lot of that very near dated picking up nickels in front of the steamroller. But I'm pleased to say there also is some meteor put action on the docket this week. In particular, a strike that probably won't surprise you, given the fact that we're hanging out where we are right now. The 3,700 puts going out tomorrow have been the most active contract this week, with nearly 45,000 contracts on the tape. Trading it up pretty much all week long. The big day was Tuesday, nearly 15,000, 11,000 on Monday, about almost 10,000 on Wednesday, almost 10,000 today. It's been back and forth opening to closing. So as we continue to threaten that 3,700 strike, folks loading up on there. Then as we retreat, taking them off, back and forth, 3,700 puts. So it's not all nonsense 32 half puts. Still a lot of those, but there's also a lot of other meat to be found on the bone. 3,800 puts also looking pretty active this week, about 33,000 of those. The big day was Wednesday for those, nearly 11,000 on the tape. But it's really the 3,700 puts, pretty active across the board, going up in the SEP contract. The end of month SEP contract has 8 days to go, so 27,000 of those going up this week as well. So 3,700 puts, pretty active as well. In the week 1 October contract, about nearly 10,000 there, almost 1,000 going up. And yeah, just across the board, 3,700 puts were where the action was this week. Not to be outdone, there are some, shall we say, intriguing prints going up this week. How about, let's say, the 2,100 puts going up nearly 5,000 times this week in the week 3 November contract. Trading Tuesday, 2,751 times, all opening, and 2,000 going up today. So 2,100 puts. That's not a strike I thought I would see today, but alas, we see weird stuff out here. And also 6,200 calls, if you want to get crazy, listeners, out here in the SEP contract going up about 1,000 times this week as well. So there is some interesting and or aberrant paper going up this week to sink our teeth into. Before we roll out of equities, let's also look at our friends out there, the Russell 2000. Russell 2000 lighting it up this week. Like we said, it was pretty active. It was number 2 to the dark side in our movers and shakers this week, coming into showtime 1724. So now well below that 2,000 level, getting just shellacked this week off 79 handles just this week, or 4.38%. Obviously, if you go back to end of last week's show, we're off over 5%, about 5.25%. So a pretty rough week here for the Russell 2000. We're seeing a pretty decent amount of action out here in the week 3 October contract. Has about 30 days to go. So we're a little bit farther out in this equity, which is somewhat refreshing. The vol out here about 31.25, up 1.8 points. Skew-wise, the puts last week, 7.4% bid. This week, 8.2% bid. The calls last week, 7.3% cheap. This week, getting cheaper, 9.3% cheap. And in terms of action, what was leading the dance out here in the Russell 2000, listeners? It was the 1,700 puts. So, actually, I take it back. The 1,720 puts leading the dance out here in December. Those were pretty much the number one trade out here. 1,720, interesting strike. And followed right behind it by the 1,700 puts out here in the end of month October contract. All trading pretty actively throughout the week. And also, not to be outdone, we've got some 1,800 puts going away tomorrow. Now in the money puts, trading pretty actively out here as well. So looking for interesting and or aberrant prints out here. Looks like 17. Actually, no, I take it all back. It was the 1,780 puts going out at the end of this month in about 8 days that we're actually leading the dance. So a lot of put paper, as you might expect out here, and also a lot of action in the 16 half puts in the October contract as well. So it's pretty much a put strip across the board. 1720s, 1700s, 16 halves, and 1780s, as well as 1800s lighting it up this week out here in all things Russell 2000. As we keep on rolling, listeners, out of equities and into a complex that's been on a lot of people's radar these days and is actually once again on our movers and shakers. Number one to the dark side this week is energy.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, everyone. Welcome to the crazy world of energy these days. I got so excited with the last complex, I forgot to explain to you how you can follow along with the show proper. Listeners, head on over to cmegroup.com/TWIFO. That will generate those reports for you completely for free because we like you. Then go into that asset class drop down, go down 3 classes to energy. That's where we're going to hang out there first and then pop it over into nat gas. Mr. Rich, before I dive into that, obviously energy has been top of mind for a lot of people out there. What's catching your eye out there in the world of energy? And have you been cooking up any intriguing trades out there since last we spoke, sir?
Energy has been something that hasn't really been on my radar. I mean, it's something we're always watching, of course. I mean, with everything that's going on in Europe and the fears and expectations going into the winter season, it has been something that has definitely had a lot of moves, as you can say, but as you can see, I should say. But it hasn't been something that I've been actively involved in, just because I feel like I might be the sucker at the card table right now, Mark. So I'm trying to watch from a distance.
If you don't know who the sucker is, chances are it's you. I get that. If you're not so well-versed, if you don't watch it day after day, I feel that when I look at lean hogs, for example. It's like, what am I missing here? What is the paper flow here that I'm missing here? So yeah, and in that gas, I could certainly see. I'm sure a lot of our listeners feel that way as well. In fact, surprisingly, given the fact that nat gas is our number one dark side offender this week, listeners, actually kind of light on the paper front. 285,000 contracts. Normally a week like this, we would expect somewhere north of 400,000 contracts, and we're not seeing that this week. So kind of interesting, especially given the fact that we are threatening the 7 handle as we speak, 7.14 coming in to start the show, off about 62 cents or about 8% on the week. If you want to deep dive into nat gas and a lot of interesting futures options discussion, make sure, if you didn't check it out already, check out our pro Q&A with Carly Garner. She's been a guest on this show many times, answering all your questions. She was talking a lot about nat gas and that as well. And she has some thoughts about what happens to nat gas if it does dip below the 7 handle. So check that out. If you're not on the pro side, theoptionsider.com/pro. It'll be there waiting for you along with everything else we have there in our exclusive pro podcast feed. But interestingly enough, nat gas deciding to do its best equity impersonation this week, because closing in on 300,000 contracts and nearly half, 43% going up in the contract that goes away in 5 days. That's very interesting for nat gas, and it shows you just how much focus there is on the near-term moves. Everyone's got to get some gamma out here in nat gas right now, because this thing is rocking and rolling, and people are very interested in whether or not it's going to break that 7 handle, and that's pretty much what we saw this week. The 7 puts leading the dance out here this week, listeners. Nearly 16,000 going up, 15,745 to be precise. The big day actually today, almost half of that, 7,300 contracts going up just today. 3,000 exactly on Tuesday, most of that closing. 2,700 on Wednesday, 2,600 on Monday, both days opening there. So back and forth as we threaten the 7 handle, then retreat from it. We're seeing a lot of opening and closing paper throughout the week there. Let's go a little bit farther out to see if we can find any other months and cycles we can sink our teeth into here. If we go out here to November, then we go to that contract. The vol out there, by the way, is about 90 listeners in the November contract, up about 2 points, 85 in the contract going away in about 5 days. In terms of skew out here in November, the puts 4.5% cheap. Last week, they were 3.6% cheap. So the puts getting a little bit cheaper, which is interesting as we continue to move lower there, taking that put wing in. The calls last week, 7.5% bid. This week, 8.8% bid. So we were talking recently, nat gas didn't seem like it had a pronounced bias in its skew this week, at least out here in the November contract. We're seeing a bid once again to the call. So as we're starting to threaten that 7 handle, are folks preparing for, bracing for, worried about a pop to the upside? That seems like what the options are telling us out here. In terms of action out here in this November contract, it was the 18 calls that were leading the dance with only 3,000 contracts. So not the most active of contracts out here this week. It really pretty much was, like I said, nearly half of the paper was in that October contract that goes away in about 5 days, and that's where all the action was. 6 half puts also pretty active out there this week, 11,000 contracts. The big day again today. So as we're seeing this move towards 7, 6 half puts also lighting it up. Also saw almost 10,000 this week of these 6 puts. The big day for those, weirdly enough, was on Monday. 5,300 going up on Monday, about 3,000 today. The rest scattered throughout the week, opening on Monday and then back and forth, opening to closing throughout the week. So interesting paper out here in Nat Gas. Let's go a little bit farther out to see what we can find. This week, it's not a 3-put strip. It's a 4-put strip, listeners, going up 3,600 to 5,200 times in a variety of months, March all the way through to looks like October here. So yeah, a big strip, a time strip yet again. That's the trade du jour out here, going up. Looks like most of it's 3,600 contracts, but 5,200 going up in the March expiration cycle as well. If you want some aberrant paper, how about the 15 calls in next January, listeners, trading 1,110 times today. Obviously, it's today, so we don't know if that's opening or closing, but there is some OI here. So this could be some folks maybe deciding to get what's left of their 15 calls and get the heck out of Dodge out here. Just looking really quickly. Yeah, no, looks like beyond that, it's mostly that 4-put strip lighting up the rest of the tape all the way out into next year. As we keep on rolling, listeners, out of energy, and because it's just dominating our upside, we got to hang out there. Let's move on into the ags. Next.
It's time to get our hands dirty exploring the latest options, trades, and trends in corn, wheat, soybeans, and more. It's time to talk ags.
All right, listeners, it's just a plethora of riches to the upside with ags this week. We had soybean oil number 5, KC wheat number 4, oats number 2, and Chicago wheat number 1. So we're going to hang out there in Chicago wheat first. Of course, pop on out of the energy sector, listeners. Go all the way up to the top of the list for ags, go into grains and oil seeds, and pop on into good old SRW wheat, a.k.a. Chicago wheat. But before we get to that, Rich, one of the last times you and I chatted, you had some interesting longer-term plays going on out there in the ag market. So let's start there. Give our listeners an update on how some of those longer-term, I believe they were time flies, which was interesting, not a trade we see very often. So that was kind of fun. Give us listeners an update on those and then anything else that's catching your eye in the world of ags these days.
You know, on the update on the timeline, I have to say I haven't looked at it exactly, but I mean a lot of the stuff that you mentioned on the light side there, we're looking at positive seasonality in corn, soybeans, and wheat, and so you're starting to see some of that take hold here, and you've seen that in the activity that we've had in the options market in those products as well. And so the question, I guess, for a lot of people might be, is it time to, is there a time to fade that, or do you really just have to ride the seasonality? And then I think as you kind of look at you look at those products, and then you have to ask yourself, one of the things we just kind of wrote about a couple of weeks ago was feeder cattle. And we've obviously seen the price of cattle moving higher, and if we see corn continue to move up with its seasonal trend, what does that mean for the other places within the ag and livestock space? And so that to me is what's really kind of caught my eye is this seasonality, and the expectation is going to continue. But what would it take to get some of that to potentially not work the way it want people are expecting it to, as we might think. 2022 has been a year where a lot of traders and investors have been confounded by the markets. Is this just another potential one we might be seeing? But that's really what's been catching my focus the most within that space is looking at, particularly most recently, looking at corn and how that seasonality is expected to continue.
Feeder cattle, I like it. Brave man venturing into the feeder cattle. It's getting more liquid these days. I'm looking at it right now, almost 7,000 contracts on the tape. So it's not the options morass that it once was out there. Give our listeners a quick glimpse. What was your trade you're looking at out there in feeder cattle?
Well, in feeder cattle, I was looking at basically getting long straddles. The implied to realized spread is fairly low, and has only gotten wider in terms of implied trading below realized or historical volatility. And so, looking at the feeder cattle, knowing that we're potentially, I always like to get long straddles if I can, in markets where you might see, obviously, of course, see major moves in either direction, and that's particularly the case when you've already had a big move in one direction. At that inflection point, could you see a bigger move? And that combined with the fact that you had, like I said, you had some seasonality in the input costs moving higher, which potentially could continue to drive that prices higher. And you're looking at implies that where the carrying cost of owning the straddle was very, very favorable. We're just simply delta hedging in the near term until the trend reestablishes itself. It could be very profitable. And so I'm like, get long the straddle and keep delta hedging until the trend reasserts, and then let the deltas run a little bit. So that's kind of what we were looking at in the feeder cattle.
I'm getting a theme for this show, Rich. Get long the straddle, getting long straddles in the E-mini, getting long straddles in feeder cattle. You're just slinging straddles willy-nilly, sir.
Well, that's a great point, Mark. And I'm typically, shockingly, usually a person who likes to sell options and not buy options. Options are insurance after all, and most companies and most people have gotten rich selling insurance, not buying insurance, right? But there's times when the market is presenting you opportunities where a lot of this risk might look high on an absolute number basis, but actually might be fairly low relative to what we're seeing in terms of movement. So, whether it be the equities that are pricing in 2% moves per day, or feeder cattle was, I think, a single digit implied volatility. You don't need much movement to really make your money back. And in a time when we started at the top of the show talking about the Fed and how aggressive the Fed's been. When the Fed is removing liquidity, that's less liquidity for the markets, and that usually means a more volatile market, right? When we saw the Fed easing policy, quantitative easing, lowering rates, that's supplying the market with a lot of liquidity. It's dampening a lot of volatility. It's driving volatilities lower. The converse is also true. When the Fed's removing that liquidity, when they're hiking rates, when we're seeing financial conditions get tighter, that's when we tend to see a higher level of volatility because there's just not as much liquidity around to kind of soak up that vol. And so that's one where if you can keep your eyes open and do a little bit of math, and you can find good places to get long insurance and make some money while you're waiting for the bigger moves.
I should point out Rich mentions too, he's not just buying the straddles and letting them fly, he's delta hedging. So he's defending them a little bit while you're waiting for that move to happen. So if you are going to go out there trade straddles, listeners, a little bit more to it than just buying them and letting the dice roll. You got to be active out there. Straddle is not a set it and forget it trade by any means, but intriguing stuff. Straddles in feeder cattle, not a thing we talked about on the show before. So always fascinating stuff. Getting back out to our number one light side mover this week, it is SRW Wheat, putting up nearly 200,000 contracts this week, 190,000 contracts. So nothing to sneeze at out here, listeners. If you're wondering where is wheat this week, 909. Up 49 and a quarter handles, or 5 3/4%, just from this week. Obviously, if you go back to the end of our show last week, it's up nearly 7%. So quite a run here for wheat, as once again, a lot of things going on in Ukraine coming into stark focus over the last week and change out here. In terms of action, where was the action this week? It was in the D's contract. It has about 64 days to go. The vol out there is about a 44 even, up 6 1/4 points this week. Skew-wise this week, 8.4% cheap with the puts last week, 6.9% cheap they were this week. Calls last week were extremely bid, nearly 16% bid. This week they've come in quite a bit. They're 7.5% bid. Still frothy, but nowhere near what they were last week. So what you have here, listeners, is pretty much an inverse equity skew. It's a pretty typical commodity skew here, bid to the calls, discount to the puts. And in terms of action, like I said, about almost half, 47% of the paper went up in the D's contract this week of that nearly 200,000 contract week. And as we're threatening the par strike, the 1,000 strike, not surprising that would be the strike that captures the imagination this week. The par calls trading nearly 12,000 contracts this week. The big day was yesterday, 6,100 yesterday, 3,900 on Tuesday, almost 1,000 today, and about 700 or so going up on Monday. Back and forth opening to closing throughout the week. The big slew that went up yesterday was actually slightly closing. So maybe some folks were getting off the par strike before we blew through it, or maybe perhaps we weren't reaching it in time for their taste. Either way, some closing paper on the par strike there yesterday, followed by the 1,100 calls also lighting it up yesterday. 11,300, I should say, this week. 11,300 on the tape this week. The big day for those, weirdly enough, was Tuesday. Almost 9,000 going up on Tuesday. Mostly opening there, 2,100 on Wednesday, and not much else trading the rest of the week. It was pretty much all Tuesday and a little bit of Wednesday. Then, not to be forgotten, we have the 1,200 calls as well, 7,750 of those. The big day for those, also Tuesday, 5,800 on Tuesday, 1,700 on Wednesday. And again, not much going on today or Monday there. Beyond that, looks like the par strike was kind of where the action was across the board. The par strike also lighting it up out here in November to the tune of about 5,400. So not surprising that that's the strike that's fixating a lot of the imagination. It is a very round, important psychological level. Those pars in November were trading pretty actively all week long as well. The big day for those, 2,500 on Tuesday, 1,400 today, 1,300 on Wednesday, and just a couple of hundred on Monday, but all opening all week for those. So a little bit interesting, a little bit different paper out there in the wheat. We saw a lot of ags out here this week. So I mentioned oats don't really do a lot of paper. Casey wheat, we already broke down wheat. We talked about feeder cattle out there. Let's do a quick sojourn as well, since we mentioned the beans were lighting it up this week as well. In particular, soybean oil. We'll go out there as well. A decently active week for them as well. About 36,000 contracts on the tape. Soybean oil right now, about 69 and a quarter in that front future, up about half a buck or about almost a full percent on the week. Obviously, go back to last week's show. It's up about 3.2%. In terms of paper, we said about 36,000 contracts, almost half, 43% of the paper going up in the D's contract that has 64 days to go. And looks like it was actually a pretty close tie between the 60 puts going up in D's doing almost 2,400 contracts, as well as the 70 calls going out tomorrow, also trading pretty actively. 2,500 of those back and forth all week long. So as we're threatening the 70 strike, no surprise that we're seeing a lot of paper going up in the soybean oil 70 calls. Again, trading actively all week long, 2,500 total, back and forth, opening to closing all week long as well out here. In soybean oil, so for some other interesting prints really quickly, 60 puts and 70 calls. Also saw the 65 puts going up out here in November, doing, it's like a 65, 66 put spread going up today 1,000 times. That's a strangely tight spread, but we've seen weirder things trading in WTI and other products recently. So we'll chalk this up to the usual weird aberrant put spreads. Again, 1,000 of that going up today as well. All right, Rich, we've hit on equities, we've hit on energy, we've hit on ags. You are our guest. I will allow you to choose where we go next. What complex is lighting up your tape this week, sir, you want to talk about?
Well, I think the most interesting place to look is what happened overnight. So maybe looking at foreign exchange is a good place to.
I think we can do that, sir.
The dollar, the euro, the yen, and more. It's time to explore what's happening in major currency options around the world. It's time to talk FX.
All right, listeners, this is a drop that we haven't used that much in the long history of this program. In the last couple of months, it's starting to make it onto our radar more as, of course, the dollar surges and we see other corresponding moves in other major currencies out there. So if you want to find FX for yourselves, listeners, go on into that asset class drop down, pop out of ags, go all the way down to foreign exchange. Then we're going to pop in FX majors. I have a feeling that Rich is going to want to talk about the yen this week. Is that on your radar as well, sir?
It absolutely is. So, yeah, I mean, as I mentioned before, I started my career in foreign exchange. So I know very well that there are long periods of time where FX doesn't matter. But then when FX starts to matter, it's the only thing that matters. And so I think when we look at foreign exchange, we have to look at ultimately, what does that mean for the flow of funds? What does that mean for the flow of capital? Does that, what does that mean for where investors are going to look and seek a return on capital? And one of the things I've been talking about all year has been the yen, has been the decision by the authorities in Japan to say to the rest of the world, hey, you know what? I know you've got this inflation problem that you're worried about. We gladly take some of that inflation from you. So they did that by keeping their policy extremely easy, by pegging the 10-year yields still very close to zero, while yields in every other country were going higher. The resulting effect was that the yen weakened. And as the yen weakens, it starts to gain momentum because it's a potential source of funding or a funding currency. And so leverage accounts would look to to borrow swap out of their yen into other countries to make their levered investments, but also because the Japanese pool of savings is one of the largest pool of savings around the world. And so some of that money starts then to pull back domestically and repatriate. This has tremendous repercussions for a lot of markets. It has a big repercussions for the treasury market. It's a source of buyers that may not be there, right? It has repercussions then as a result. It has repercussions even for equity markets. And on top of that, when you start to see the yen weaken and start to accelerate on its weakening trend, we had this idea that people have kind of put forth of the dollar wrecking ball, right? The dollar broadly against most currencies had been on quite a tear this year. And when does that start to cause some problems? Well, it starts to cause problems when countries who borrow in dollars and have to repay those dollars, even though their revenues might come in a foreign currency that is weakening, start to get squeezed on their dollars. And the other way you start to see it is if you start to see other countries wanting to weaken their currencies as a way to remain competitive versus Japan. Namely, that would be China, which is a managed float, but where China has been actively weakening its currency in a way to try to keep pace with what's going on in Japan, because they're both export-led, centralist type of economies. And so the move in the yen this year, I thought, has had some very major ripple effects across all of the different asset classes that we look at. And then last night, the Bank of Japan said, okay, that's enough. We've gone too far. Right? We started to approach 146 in dollar yen, and Bank of Japan said that's where we're going to draw a line in the sand. They intervened. We saw a very sharp drop in price, 5 handles down to 140. And what did we immediately see? We saw stocks immediately rally. We saw bonds immediately rally. We even saw crypto start to rally because of that, right? A potential risk flare being maybe mitigated a little bit by intervention from the Bank of Japan. Now, what we've seen subsequent to that is the market's going to go and retest the mettle of the Bank of Japan tonight. It's if they say there's a line in the sand, the market's first response is typically, well, let's just see what you really mean by that. And so I would expect a little bit more of an interesting night in the Asian markets tonight on the back of that. But I think this is something where people in a lot of different markets don't always think about what's going on in foreign exchange, because for the most part, a lot of times it doesn't really matter that much. But when we get these major trending moves in major currencies that has tremendous repercussions across the globe, it's something that as investors in any asset class, we want to pay attention to.
I like that. That is true. When FX doesn't matter for long periods, then all of a sudden it's on our radar and it becomes extremely important. How much have we been talking about the dollar pretty much for the last couple of months, right, Rich? It's been a huge talking point for just about everything that's been going on out there. So let's head on over to the good old yen USD. Listeners, check out what's going on out there right now. If you're wondering, if you don't follow this spread, you're at a 0.007 out there right now. I won't bore you with all the decimal points out there. Obviously, things get pretty intricate when you're talking the prices out here in the FX rates. In terms of how much paper is going up in the yen USD, a pretty decent week, about 25,000 contracts on the tape. Again, given this historic action, maybe you'd expect a little more, but a decent pop nonetheless. And of that, about 30% going up in the contract that has about 15 days to go. So going out really in that first cycle there in October. And in terms of vol, again, FX never really been known as a bastion of huge vol outside of aberrant circumstances, like the black swan, the Swiss franc and things like that. It's kind of like the rates complex. You don't really go there for vol. It's looking a little frothier this week, though. 1485 out here in the yen USD. It's up about 1.25 points. So you're starting from a low baseline, obviously. That's a pretty decent vol move out here. And in terms of skew, last week, the puts 2.3% cheap. This week, almost 3.5% cheap. So puts getting cheaper. The calls last week, 4.7% bid. This week, 7.1% bid. So the options are obviously leaning to the upside, putting that bid into the calls. And that is probably because we're seeing the 0.0074 calls. I love the strikes out here. These strikes just roll off the tongue in the yen USD here, Rich. The 0.0074 calls doing about almost 1,000 contracts this week. Doesn't sound like a lot, but for yen USD, it's actually a fair amount of paper. And as you would expect, all of that paper pretty much going up today. The rest of the week kind of quiet. That was followed hot on its heels by the 0.0071 calls, doing a whopping 537 contracts. A little bit of a stark contrast there. The big day for those was actually Tuesday, not today. So intriguing stuff out there. Let's see. We also had some action in the 0.0076 calls, doing about 500 contracts as well. Those being actually evenly split between Tuesday and today, weirdly enough. So interesting little pockets of paper lighting it up here throughout the week. We've also got the 0.00725 calls going up out here in 1 week beyond. So mid-October contract has about 22 days to go, doing actually exactly 1,000. So I take it back. Those are actually the big dog out here this week. And that's all trading today. And it's nothing else throughout the week. No other strikes around it. So it's not a spread. It's just straight up someone loading up on the 0.00725 calls here 1,000 times today. Interesting stuff. Nice staccato bit of paper. Is this kind of the paper you were expecting, Rich, or were you perhaps expecting a little bit more paper given the somewhat historic news that happened this week?
Yeah, I would say that I would expect a little bit more paper for sure. But I mean, so like just to kind of draw a parallel, because the levels I was mentioning before were of course in the spot dollar yen, and we're looking at the inverse here. But that 0.0725, that's an equivalent of about 138 in spot dollar yen. If you're kind of comparing and contrasting. So yeah, what you're seeing is some of the flow is suggesting that maybe the Bank of Japan, maybe there's either think of it one of two ways. Either the Bank of Japan is going to be successful and strengthen the yen at this point, or it's people who are short the yen. Maybe they've borrowed in yen and swapped out of it, and they just need a little bit of a hedge. And so either one of those, I think it kind of suggests that perhaps the weak side of the market might be on the yen call side.
Intriguing stuff. Rich is right, of course. We're talking yen USD here. You may think of it as USD yen, so we're talking the inverse here, you listeners, if you're wondering why those levels are different out here. We got a little bit of time left before we get the listeners on the show, Rich, so I will allow you to choose our final complex. Where should we hang our hats last this week, sir?
Well, I would suggest maybe take a look at crypto. We had a big catalyst this week, and we've got perhaps some new product coming down the pipe.
All right. Well, I think we can make that happen as well. To crypto we go, listeners.
It's time to explore the volatile world of Bitcoin, Ether, and more. It's time to talk about crypto.
All right, everyone. Welcome to the wild, the woolly, the just sometimes head-scratching world of crypto. Pop out of that FX asset class, go up 3 slots to cryptocurrency. We're going to hang out in the big dogs first, but we can probably explore some micro as well. Rich, as you mentioned, new products launching. We just had Tim McCourt on the show last week. So now, in addition to the futures and options on the big Bitcoin contracts, and of course, we have the futures on Ether, and then we have the micro Bitcoin options and futures, and of course, the micro Ether options and futures. We now can add to that list options on the big Ether contracts. So for those big funds out there looking to sling 50 Ether, now you have an option out there. But Rich, I know you're always looking at interesting trades out there for your Excell with options. Have you started to dip your toes into the crypto options at all?
Well, I tell you, a couple of weeks ahead of the merge, which was the big catalyst in Ether that came out September, last week, Thursday, September 15th, we were looking at trading catalysts, trading in Bitcoin options and anticipating what we could be doing in Ether down the road with those types of catalysts. And the other thing to bear in mind with crypto is I think oftentimes people think that it's an uncorrelated asset, but what we've seen as institutions have moved into the crypto space, the correlation of crypto to other riskier assets has gone up considerably. It's gone from what was actually a negative correlation back a few years to a very strongly positive correlation. And especially when we look at something like Bitcoin, where there isn't any near-term yield, it's what we would call a long-duration asset, because all of the value for Bitcoin comes from the future. It doesn't come from anything current. And those are the types of assets that don't do so well in periods of rising interest rates. And so if you're looking to trade around a catalyst in Bitcoin, for instance, you would be looking for trying to anticipate when we might see that peak Fed funds, because that might be the time when we get the Fed foot off the neck of something like Bitcoin. Ether, on the other hand, is to me is quite interesting, because now with the merge, with the move to proof of stake, with those who are staking their ETH as a way to validate the blocks, what you're seeing is that the potential to earn a fair bit of yield, as you stake your ETH onto the chain. And so if institutions are looking to do that, when you do that, you have to lock up your ETH for a long period of time. In fact, right now for an indefinite period of time. And so with these options on Ether futures coming out, it gives the institutions an opportunity to put hedges on because they're not going to be able to sell out of their cash Ether. And so I would expect to see a fair bit more activity from the institutions into the options and Ether market as we're seeing more people accumulate that, look to stake it to earn some yield, but have to potentially hedge themselves from the volatility we're seeing in the markets. And so I'm really potentially very interested in both Bitcoin and Ether for probably different reasons as we look through to the end of the year, because while that merge some would say that was a bit of a non-event as we went through the catalyst, I think it's really kind of setting itself up to see how is the execution of this going to be, and is this something that we could potentially see trending. And so that to me is really kind of got my antenna kind of raised and keeping an eye on what's going on in developments there. And I would expect I'll be writing about those in the not so distant future.
That's interesting because you're right. The first takeaway from the merge was that it was a bit of a non-event, right? For all the buildup, not as much really trading or really moving out there. But yeah, interesting. You're looking farther into the future on Ether. That's fascinating. Unfortunately, listeners, we don't yet have the big Ether options propagating through the TWIFO report. I expect them to add those pretty soon. So we're not going to be able to look at the numbers for those new products just this week. But we'll head on out to a micro Ether, and which is interesting. I would have expected, the week post-merge, a little bit more paper on the tape. This is something that Carly Garner was complaining about in the show recently, too. The liquidity out here in the micro Ether options still kind of somewhat hit and miss, and that's Exhibit A by this week. Only 1,957 contracts have gone up this week, so kind of a quiet week given, as Rich was just saying, all the things that just happened that people are looking forward to out there in the ETH market, and, of course, all the headwinds that are amassed against crypto right now from a macro perspective. You might expect a little bit more paper out here. And also, as you mentioned, maybe some puts for folks out there who are looking to hedge. And yet it was the 1,300 calls doing the lion's share of the paper, and pretty much all of that today out here in the micro Ether. By the way, Ether right now, listeners, hovering exactly at about a 1306. So we are pretty much right at that 1,300 level out there. So intriguing stuff. Unfortunately, not a lot of paper to parse out there. But if you want a deeper dive into all things crypto, of course, check out our Crypto Rundown program every Monday. As we keep on rolling into your segment of the show, it is time for your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everyone. Welcome to the Futures Options Feedback segment. We're kind of coming up against it here, so I'm going to squeeze in a couple of our polls. Then we'll get the heck out of Dodge for this week. Listeners, last week we asked you folks, when did you start trading options? Gave you 4 choices, just started this year. The pandemic rush, the post-Great Financial Crisis, or the old school, quote-unquote. For terms of this poll, is pre-2009, even though that's pretty new school to most seasoned options vets. But don't have infinite room on Twitter, listeners. Got to make some concessions sometimes. And post-Great Financial Crisis won with 45.9%, followed by number 2, old school, pre-2009, 29.7%. The pandemic rush, 21.6%, and just started this year, 2.7%. Let's look at our question of the week for this week, listeners. And we're asking you, this was a debate that kind of popped up given your feedback on our Options Bootcamp show that we put it out to the full audience this week. And we said, inspired by your feedback on that show, it seems like we might be in the middle of a bit of a quote-unquote iron condor renaissance. The strategy was super hot over a decade ago, really. but seems to have cooled in recent years. Is it making a comeback? Gave you 4 choices. Yes, it is making a comeback, and I am trading iron condors right now. Or no, it's not making a comeback, and I prefer iron flies. No, I prefer butterflies, or they never went away. Mr. Rich, I'm curious for you, what is your vote if you have one? And B, what do you think our audience is voting for?
I'm going to say that your audience is going to say that they prefer butterflies because they probably prefer something directional. But I think, in my mind, they never really went away. But of course, I'm the one that's been advocating buying straddles this week, so I don't know if iron condors is going to be what I would vote for this week. But generally, to me, iron condors are probably one of the best ways to get short volatility if that's what you want to do.
Well, our audience is agreeing with you right now, Rich. 47.8% saying, yes, it is an iron condor, assance, and they are trading them. Followed by number 2 saying, nope, it's not an iron condor, assance, and you're not trading them. You prefer butterflies. Number 3, 13% saying they never went away, so they've been hot all this time. I may disagree with that, but we shall see. And then number 4, 8.7% saying, no, you prefer the old school iron butterfly. All right, everybody, that music means we come to the end of another sojourn through the world of all things futures options. Before we go, Mr. Rich, if folks want to check out your reports, see what straddles you're slinging, perhaps in feeder cattle or in FX, or where should they go? What should they do?
Well, the best place to go is to look at my Excel with options reports that I do for the CME group. And that's going to give you specific trade ideas that look at every other week, look at a different asset class. If you're just looking for broader macro thoughts of what's going on in markets writ large, I would encourage them to go to my Substack at stayvigilant.substack.com. So 2 different places for 2 different things. It depends on what they're interested in.
There you go. Check them out. You can find those Excel with options reports over there. The same place you find our TWIFO reports, cmegroup.com. Check them out /TWIFO for all the reports, or search for the Excel with options. I said before, once you get over to that CME website, you can be pretty busy over there. You got education, you got research from the likes of Blue and everybody else. You got Rich's reports and a whole bunch more over there. And of course, you know where to go to learn about all things small caps. FTSE Russell, FTSE Russell.com is the place to go to kick the tires and light the fires over there. Give them a follow on Twitter while you're at it, at FTSE Russell, all one word. That's going to do it for us today on the network. Back again tomorrow, noon Central, 1 p.m. Eastern for volatility views. And then after that, for all you cool kids in the secret club for options oddities. Then back again next week, all the way through to another Thursday, another episode of This Week in Futures Options. Stay safe out there, everybody.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.